Welcome back. This is Dr. Frank again on our educational video series. This topic is very important to most people, and that has to do with Social Security. Now, is one of the pillars of potential income sources, pension, savings, part-time work, Social Security is a key factor. So what we generally look at is identifying what it costs expense-wise for a client through retirement. And here's a case where $50,000 would be their expenses. And then we look at the guaranteed income, Social Security and a pension. In this case, it's $30,000. So what we would do in that case is we have to fill this income gap of $30,000 somehow. Now, one of the things that's very important to avoid outliving your money is to have a withdrawal rate from your assets between 2.5% and 3% of the value of your portfolio. Now, it used to be 4%, but people are living longer. So, for example, if you have $1 million portfolio, you shouldn't draw more than, let's say, 3% or roughly $30,000, $33,000 a year. And this is particularly important in the early years of retirement. Now, Social Security is a key component of income for most retirees. It's more than like 30% in most cases of their income. And it involves a benefit calculation based on the number of years that you work, the 35 highest earning years, etc. And if you don't know what that number is, you can go to socialsecurity.gov and you can register there and get a statement from them as to what your income would be at ages 62, full retirement age, or as maximum it's age 70. Now, sources of income for retirees, as you can see, Social Security is a major source of income, about 36% for the average retiree. So that's a key factor that we do this thing properly and optimize the proper timing for turning on Social Security. Now, full retirement age, or FRA, which is your full retirement age for benefits, varies with the year that you were born. So if you were born in 43 to 54, it's 66, then it increases all the way to 67. So most baby boomers are in this range here, somewhere around 66 to 67. Now, a question that we get many times from our clients that want to retire early is, when should I turn on my Social Security? Should I do it at age 62? Should I wait till I'm full retirement age around 66, 67? Or should I defer it as late as 70? Beyond 70, that's the maximum amount. And here's a graph that shows the difference between starting it at 62. You're going to get a reduction in benefits of about 25 to 30%. So here's a case where you get $1,350 a month versus about $1,800 when you get turned 66. So there is a significant increase. This increase here is roughly 7 to 8% a year. All right, now if you go ahead and wait until you're age 70, you can see this thing goes up to as high as almost $2,400, again increasing about 8% a year. So there's a significant difference between taking it at 62, 66, and 70. And that's shown in the following graph. Here's a client, for example, that retiree that started at 62 and receives $1,350, and then it increases all the way, basically almost doubles at age 70. And that's significant, especially if the primary wage earner is the husband, let's say, and the spouse didn't work that many years, for example. Then the wife is entitled to half, roughly, of her husband. So if you retire here, then your wife would only get half of this amount, around $650. So that would be a total of about $2,000 versus half of this, which is another $1,200, which is $3,500. So that's a huge difference, and we counsel our clients to make sure that we optimize this and do it correctly. Now, you might ask the question, what if I need the money when I'm 62? Well, quite frankly, if you're physically able, I would say get a part-time job to supplement yourself with $12,000, $15,000 a year and let this thing continue to increase. Another rule of thumb is, if you know what age you think you're going to check out from the planet at, the general rule is if you think you're going to die before the age of 78, then I usually say take it at 62. If you think you're going to live beyond 78, then you're better off deferring it. But actually, who knows when that's going to happen. All right, now here is a very important point that I kind of alluded to, is the spouse gets about 50% of the maximum wage earner's benefit. And that's very important. Also, you can claim if you're been married for at least 10 years, let's say you're divorced, and you were married for 10 years or more from one of your spouses, then you can collect based on his. In fact, you can actually do it multiple times. So if you've been married twice, 10 years to Mr. Smith and 10 years to Mr. Jones, and you can collect both. So that's kind of interesting. All right, now let's take a look at a benefit here of the difference between starting the benefit at 62, 66. Here's a case with John and Beth at age 62. You can see that the total income is $1980, whereas if they wait until age 66, it would be about $3,000. And then if they wait until age 70, it's almost $4,000. So $4,000 relative to this number here is about twice as much income at age 70. Now, the other question is, a lot of folks that retire particularly early, like in late 50s, early 60s, might want to defer the taking Social Security. This is what we generally recommend, and work part-time. But when you do work part-time and you're not at full retirement age, the government actually will dock your pay a certain amount. So, for example, if you are working before full retirement age, they will deduct $1 for every $2 at earnings that exceed the limit of $17,640. So you can earn $17,640 in 2019 without having your paycheck docked. But if you go over that, then it's $1 reduction for every $2 in earnings. And then if in the year in which you reach full retirement, they only dock $1 for every $3, and only that is an exceeded annual amount in excess of $46,920 in the year of full retirement. And finally, after full retirement, you can work as much as you want, and your earnings will not affect your Social Security benefit. Okay, the other question that comes up is your Social Security benefit taxable? Now, when the Social Security Act was passed by Roosevelt in 1935, it was not taxable. However, we know how our government operates. Sometimes it tends to be a little bit inefficient, let's say. So what happens is they have an increasing debt, so they have to levy taxes. So this is how it works. If your income and you're single is between $25,000 and $34,000, then 50% of your benefit is taxable. If your income is you're married and your income's between $32,000 and $44,000, then there'll be 50% is taxable. And then in addition to that, up to 85% of your benefit can be taxable if your combined income is over $34,000 and you file single, and over $44,000 and you file married. So basically what it says is, hey, we had to change the rules because we couldn't balance the budgets, therefore we have to tax a benefit that originally was designed not to be taxed. And then here is the thing that is really an eye-opener, this little footnote. In calculating your income for purposes of assessing this tax, they take your adjusted gross income plus non-taxable income plus 1/2 of your Social Security benefit goes towards that. So that is really, really a difficult formula to avoid being taxed unless you're making, you're pretty much at the poverty level. Okay, now there's some strategies that we use. We have software that we use for optimizing Social Security for both spouses. It's pretty complicated. There used to be a strategy called File and Suspend, which was a really great strategy, but they did away with that last year. But there is one left strategy that's called Restricted Application, and it's referred to as the Free Spousal Benefit, okay? Most people never heard of this, but basically one spouse files first for retirement benefits on his own earnings record, okay? And they have to be at full retirement age to do that. And then the other spouse files a restricted application for spousal benefits. So, and then later on, that spouse switches to his or her own benefits. So what does that look like? Well, let's take a case of Charlie and Mary. Charlie's 66 and Mary's 65. They both would like to retire now at the same time. So Charlie decides that he wants to claim his full retirement benefit of $2,800. Mary's 65 and she's decided that she wants to defer hers until she's age 70, but wants to start collecting a reduced Social Security benefit now so they can have some income for having some fun and travel. So they file a restricted application so they can retire at the same time. And this is what it looks like. Without this restricted application, Charlie gets $2,800, Mary gets $1,400 reduced amount, total benefit is $4,200. With the restricted application, when Mary reaches 70, she gets a bump raised to $2,640, so now the total income here is $5,440. Now that's a 30% increase in benefit. So this for strategies is a strategy that we use for some of our clients if it fits their overall retirement plan. Okay, now survivors benefits, this is important that people know this because we've been asked this question a number of times. Let's say that one spouse earns $3,000 a year, and let's say that's the husband, and let's say the wife earns $2,000 a year, a total of $5,000. If the husband dies, okay, or the spouse dies, the surviving spouse gets the larger of the two. So in the case where the gentleman gets $3,000 and the wife gets $2,000, if the husband dies, then the wife gets stepped up from $2,000 to $3,000. So now she gets $3,000 a month instead of $5,000 a month. And that's a significant drop in income. And when we do our plans together, we make sure we look at the what-if scenario and the risk associated with that happening. And in that case, we might, depending on the health of both spouses, we might put life insurance, let's say, on the husband to make sure that if he dies sooner, that we can cover that gap, that income gap. Okay, now basically, we can't tell our clients what they should do. We can only make a recommendation. But basically, if you need to take Social Security as soon as possible at age 62, we would encourage you to consider, if possible, if you're able to work part-time and earn $10,000 or $15,000 a year, and then defer it at least full retirement age. Okay, so it's a personal choice that has to be made, but we have the technology to be able to optimize that for you. So this is a very important part of your retirement income because this is guaranteed for life, and there are cost of living increases in it so that it's indexed to inflation. So that's a very important part of your portfolio. And we have the ability to be able to calculate and optimize that for every client based on their age, when they start, etc. All right. Again, one last item, and that is employer pension basics. If you're retiring from a company and you have a choice typically of taking a lump sum or an annuity, the annuity can be either single life annuity, a joint annuity, or some other option like a lump sum. Usually, unless you were a school teacher or a government employee where they get cost of living, other folks, like if you retired from Microsoft, ExxonMobil, whatever, there's no inflation or COLA adjustment. But government workers and teachers usually get a cost of living increase. Now, what we generally do with our clients, if they have a choice of taking a lump sum or an annuity, single or joint life, we can work the numbers out and find out what is the best way to go, because we have options like annuities, because basically a pension is an annuity. We have other annuities that we can go ahead and calculate, and they have increasing income in some cases, and we can tell them whether or not it's best to take the company's annuity or whether there's a better one that's available in the outside market. Okay? So we do that for a lot of our clients. All right, again, the disclaimer, and we look forward to hope you're enjoying the educational video series, and we look forward to seeing you on the next video. Thank you.